Some think it is commercial mortgage-backed securities that may lead to the next financial downturn as property values continue to fall and default rates rise. One industry that did take a major hit in 2008 and early 2009 was the life insurance business, partly because they were heavily exposed to mortgage securities. But my next guest is actually upgrading the entire industry after research that U.S. life insurers will sidestep losses tied to commercial mortgages. Joining us now to explain is Barclays Berg, senior analyst at Barclays Capital. Hi, Eric. So if U.S. life insurers have significant exposure to this vulnerable commercial mortgage industry, why upgrading them?
Well, we actually have a list of reasons, and I'll get into that list in summary form, but critically at the top of the list is something that you referenced, which is life insurers' exposure to commercial mortgage-backed securities, and our research, which we published the day before yesterday on Tuesday, in which we concluded that while losses are definitely piling up in commercial real estate, these losses are, at least in commercial mortgage-backed securities, in commercial real estate and commercial mortgage-backed securities, what we found is that these losses are really piling up at what I'll call the level of the deal or the level of the securitization. And that when one takes into consideration the subordination or protection against loss that the life insurance companies enjoy because of the specific tranches, bonds, securities that they purchased, their losses will ultimately be inconsequential, both on an absolute and relative to book value basis. So there's a list of reasons, but topping the list is our view that CMBS-related losses will be inconsequential.
So you're saying that the life insurers carried the most senior level of debt there, and that possibly explains why hedge funds and banks were more on the hook for losses because they were on those lower tranches?
That's exactly right. In other words, our conclusion, in all fairness, is really not new. And by that I mean that the insurers have been saying for months, for many quarters, that because of their position in the capital structure of these securities, you correctly referred to them as senior, that they're not going to take any losses. I would say what we wrote is that, in all fairness, investors should really not have any view on these assertions because the insurers have just sort of stated them without really providing a lot of detailed evidence to back up those assertions. They provided the ratings.
Just wanted to ask you, we only have about 30 seconds. I do apologize for that.
Sure,
Which life insurers are the best to invest in?
Well, one name that we did upgrade based on this was Principal Financial Group. The concern about Principal's exposure to mortgages in general and to mortgage-backed securities in particular have been running probably deeper than any other insurer. And so that's one company that absolutely stands out in this regard. I'd say that Metlife, too, has a very large CMBS exposure, and our research bodes well for the absence of losses from it.
Many thanks to Barclays Berg, senior analyst at Barclays, talking about the life insurers today.